Crocs is one of the biggest comeback stories in the market. From $6 per share in 2017, it shot up all the way to 180. It came back down now. It's currently trading at a 7 PE, and that is where people usually look at and say, hey, is this a buy at this moment now? As well, the explosion came because Crocs was revived as a brand. Currently making $4 billion in revenues, buying back shares massively, and generating huge amounts of free cash flow. Nearly $1 billion in fact, with very minimal dilution. And Crocs is a very easy to understand business. It's not complicated. There's Crocs and the recently acquired Hey Dude. Crocs is the legacy company of the iconic shoes that everyone knows. And this is the cash cow for business. Huge margins, good revenue, and then there's Hey Dude, the recently acquired problem child. And I think this is kinda where management panicked. Because what I think went on in people's head, they saw that Crocs stagnated for a long time, then came back. The money was there, everything was going great, and they were thinking, hey, what if Crocs reverses? We need to diversify from our great, fantastic business into other segments. So for $2.5 billion, they bought Hey Dude. And how is that going in the 2024 year? Minus 13% revenue growth. Lower margin than Croc. Now they're saying they're refreshing the brand, improving it, that they're going great on social media, that they're expanding into other markets. But if you're expanding into other markets, why is the brand still struggling? Simple. It is not Crocs. It doesn't have the same energy as Crocs. This is a weaker brand that they bought. They hugely leveraged up $3 billion in debt. Now they're still slowly paying that down. Well, slowly, they're massively actually paying that down. However, all of this cash, $3 billion in cash, at the current market price, they could have bought back 50% of stocks. And I would have rather wanted that than them forcefully diversifying. I have nothing against diversification, but when we here look in the Hey Dude performance, it is just not as good as brand as Crocs. They overpaid for this acquisition, in my opinion. Now, it's still a young brand, and Hey Dude is still growing its store count, but I just don't think it's gonna be worth it. I can understand the panic. Hey, Crocs was out of fashion. What if they come out of fashion again? We need to diversify. But I think it was just done too quickly. I think it was rushed, was too big. They should have maybe focused on some smaller brands. And I think that money is just wasted. It's not a net negative to the company. It's still an okay brand. I just think they could have rather half the share count. And when we look what they guide, hugely down. Now they're expecting it to recover a bit. Maybe if they open more stores. However, Crocs still where the revenue growth is gonna come from. And I think they also know that the acquisition was done too fast. Because when you look at their capital allocation, investing in the brands, paying down debt, repurchase shares. Nothing about buying new brands. And I think that's good. I think they should focus on what they have right now. They need to fix Hey Dude first. They need to make it a good brand. They're already way on their way to paying down the debt. So I think the recent drop in the share price was just because of a bad acquisition of Hey Dude. And then we see they're still paying down debt massively at its current scale. Since the last December quarter, they paid down $300 million in debt. If they would have put that into share buybacks, would have been an additional 5%. And I think soon they're gonna put that into share buybacks, and currently they have around $900 million in free cash flow. Now they're just starting to ramp up their share buybacks again, because, as I said, they first will focus on bringing down the debt. And now comes the scenarios. Crocs is a fashion brand, hugely difficult to invest in, because it can happen from one day to the other that the company isn't popular anymore. Just look at Nike. Everyone was throwing hand over fist, because Nike is the greatest company in the world, never gonna go away, 2021. Well, down 66% since then. So that is why I would never buy a fashion company at 20 to 30 PE. Well, at least in those sizes. So then we think, are we compensated for the risk we take on with Crocs? What if it goes back to being irrelevant for a few years again? It will always have kinda nostalgia, but it's risky. Is this at the 7 PE? Let's go through some scenarios. Now currently they make around $15 in free cash flow per share. What are our assumptions gonna be? Currently, they're buying around 8% of shares back, with the money that they are putting into share buybacks. Let's assume Crocs is gonna grow at 2%, Hey Dude is gonna flatline from now on. That will be 10% in growth. Now, in 5 years, they're gonna have paid off basically all of their debt, and I think then they're gonna increase the share buybacks. So let's go 2% higher then. I'm not gonna assume a Hey Dude recovery here. 10 multiple, so we would get a 32% discount. That would be a great buy in my opinion. However, there's a fashion stock. You might not look at Crocs as fashion or something, but it still is apparel. It changes massively from one year to another. Now what if, let's say, Crocs declines again massively? It's gonna decline by maybe 2% per year. Share buybacks are only gonna be able to keep up so and so much. 5% for the next 10 years. 5 multiple. Huge drawdown, over 50%. And this is not even the worst case scenario. What if Crocs just stops selling altogether? Cash flow disappears, no buybacks, no revenue growth, whatever. It can all happen. And that is a very high possibility in apparel stocks, fashion. So you always gotta factor that in. However, the upside is very good. Let's say Hey Dude gets revived. It actually grows again by around 2%. That is all it needs, 2%. Slightly higher multiple than with a 2.5x already. This is the beauty of apparel. It is a very risky play. You have very low debt, it's being reduced even more, you have good share buybacks, and you have a very iconic brand. Now what I fear is that they're gonna do the same thing again once they've paid down their debt. Buy a worse company. Yes, you need to diversify, but maybe do it organically. New products. And as long as they do that, I think they're gonna do good. I think they're gonna do okay. Maybe Crocs is gonna decline a bit, but even if they're slightly shrinking by 2% per year, overall the share buybacks would be enough to value that. You would need to very closely look at Crocs. I think it's gonna be a very volatile stock, and maybe I would start a small position here. I wouldn't go into a full position. However, a small position for now. If everything develops good, if the stock doesn't move, maybe increase it a bit. What do you think about it? Write down below. Have a good day.